Hello folks, Hector Deville here. In this particular video we are going to be talking about the different type of setups you may find around the London market open. Okay, basically when you sit down at your trading station searching for London open breakout setups, you may find 5 different types of price behavior. Okay, 5 different types of price patterns. My goal with this video is to show you guys all these 5 types of, or most common price patterns you may find around the London Open, and obviously I'm gonna teach you how to trade them all. Alright, at the beginning, as usual, I'll be showing you the theory, and then we'll be moving on live examples so you can visualize how all these 5 different type of setups actually look like on a real Forex chart. Alright. Alright, first of all, I'm actually going to start off with the last one. Alright, momentumless breakouts. Momentumless breakouts, as its own name indicates, if we have, basically means if we have the Tokyo range there, that's 3 a.m. Eastern Standard Time. Well, price, the London market opens up, price moves into one particular band of the Tokyo range, let's assume the upper band, and then we don't quite get any type of breakout. All right, basically price, or traders around the London and the European markets as a whole are not quite ready to punch in their trading, their trading orders, and therefore price remains stagnant around breakout points. Okay, that's why I call this particular type of pattern momentumless breakout. Simply price, you will find that it's flapping sideways around a band, okay, either of the 2 bands of the Tokyo range, right? That's obviously not the type of breakout you want to trade. That's why on a previous video I mentioned that one of the requirements is to see, as the London market opens, a momentum filled bar, okay, as the around 3 a.m. or within the first hour of the London market opening up, you want to see a momentum bar, okay, a full body bar with low wicks both to the downside or to the upside, all right, basically breaching through the Tokyo band, okay. In the other hand, again, if you see price simply meandering sideways, okay, not quite ready to take off, in the direction of the actual breakout, be very, very, very apprehensive to take that trade or to continue, considering the idea of taking trades there. If the market, again, please remember, you don't move the market, okay? You just follow the market. You are a small retail trader. You do not move the market, okay? So your job is to piggyback on the market move. If the market is not showing you any clear move, you don't want to trade yourself, okay? If the market is not ready to take off, then you are not ready to take off yourself. So you don't take trades whenever price actually meanders sideways around breakout points upon the London market open. Again, if you don't see that momentum push within the first hour and a half of the London market open, if in the other hand you see a momentumless breakout, stay away altogether. Okay. All right, let me rather quickly show you what a momentumless breakout looks like on a Forex chart, on an actual Forex chart. We're looking into the sterling pound against the American dollar on the 1-hour time frame. Always remember, you want to analyze your setups on the 1-hour time frame when it comes to trading the London Open breakout type of setup. Okay, we're gonna be looking at that particular day there. As we can see, well, the requirements kind of, the pre-entry requirements are somewhat there. We've had a few days in a row with a clear market bias. Okay, the previous days the market has been scoring lower lower highs for the day, okay, and also lower lows. The daily range box indicator prints few red boxes in a row, so certainly we've been downtrending. Then that's where the new day started, all right, and this is the actual, all right, the Tokyo range, which does happen more or less at the lower extreme, all right, of the previous day's range, so that's okay. The range has been for the Tokyo session has been rather tight as well. Okay, price has not really been trending. We've had quite a few bars simply flapping sideways. Okay, so certainly the requirements are there. Okay, so let's now take a look at the actual breakout. Okay, around the London Open. Let me mark the high and the low for the Tokyo bands, for the Tokyo sessions. Actually, let me just draw a proper trend line within my MetaTrader platform. Okay, that's the low for the Tokyo session, and I'm just gonna mark the high as well for the Tokyo session too, right there. All right, that's the upper band, that's the lower band of the Tokyo range. Let me count the bars. 1, 2, 3, 4, 5, 6, 7, 8. All right, so the London market opens in there around that time. Okay, that's 3 a.m. Eastern Standard Time. That's when we want to see, well, either the lower or the higher band of the Tokyo range to give way, either for a continuation move or for a reversal, against this, ongoing intra-week trend. Okay, now let's zoom into the 15 minutes time frame, which is the trigger chart for the London Open breakout strategy. Now let me scroll a little bit there. Okay, let me redefine the Tokyo bands. There we are. Okay, so higher band, upper band for the Tokyo range, lower band. All right, for that particular day, as established, 3 a.m. was somewhere around there. And take a look at the type of price action we get up on the London market opens up around the lower band of the Tokyo range. We have multiple bars, okay, multiple bars flapping sideways. Let me zoom in a little bit more for a clearer picture. All right, beautiful there. All right, multiple bars flapping sideways around breakout point. This is breakout point, by the way. Okay, this is the level where we are, well, where we will be actually monitoring our chart in real time to search for breakouts and to pinpoint our entry level. Now, again, please take a look at the individual bars. All right, around that time. That's the London Open. We have a red bar, a green bar, a red bar, green bar, red bar, red bar, green bar. Moreover, if I extend this line, okay, again, breakout point, let me mark the London Open, which was somewhere in there. I'm gonna mark this in red color, okay? Red color there, okay. So just take a look at the nature of price action around breakout points up on the London market. We don't really get a clear breakout, do we? Please remember that the one of the conditions we wanted to see in order to validate a London or a potential London Open breakout setup was a momentum bar, okay? Full body bar, all right? With hardly any wicks both to the downside or to the upside. Basically, what we want to see is this type of bar, that type of bar, right? You see that long red bar there, but we wanted to see at breakout point. Okay, we want to see this massive bar breaking through the Tokyo bands, well, signifying that the London session is going to be an active session, okay? That this is going to be a momentum-filled London session. That's a must-have requirement. We want to see a beautiful long bar at breakout point within the first hour of the London Open. However, we don't get that. We don't really get that. Shy breakout there, price coming back in, another shy breakout there, price coming back in, long wicks both to the upside and to the downside. That's not a good sign, guys. You want to see full candles, you don't want to see the wicks there. Another week there and another week there, and well, as a result, take a look at what happened. Price moved sideways for, this is a 15 minutes time frame, so that's 1 2 3 4 1 hour, 1 2 3 4 2 hours, 1 2 3 4 3 hours, 1 2 3 4 4 hours, anyway, 4 hours and a half. Okay, so ever since the London market opened, all the way for the next 4 hours and a half, meaning basically the first half, the entire first half of the London session, price ended up being at the same point where it all started, right? Price basically has been flapping sideways. Remember what I said on a previous video, you cannot make money when price is moving sideways. You need price to be moving in one given direction in order to profit from the forex markets. Well, this is a clear example. You cannot make money in this type of price of market conditions, because price again is just moving sideways. And the early signal of warning we got was price action around breakout points within the first hour and a half of the London session. Not a clear breakout. We didn't get the clear breakout, correct? So that's the type of conditions where you just want to walk away from your trading station. You don't want to take trades today, or at least you don't want to take trades on the sterling pound against the American dollar. You want to search for your trading opportunities somewhere else. All right. So please mind, I cannot stress this enough. You want to see clean momentum breakouts within the first hour and a half, 2 hours maximum, okay, of the London session, driving price away from the Tokyo bands, okay, momentum breakouts. This is a no-go. Okay, now that we've left the momentum-less breakouts behind, let's actually move on with valid breakouts. All right, I'm gonna leave the straight breakout for later on because it's a type of breakout that you are not going to be profiting from. Okay, I'm going to repeat that. You will not be able to profit from straight breakouts. I'm going to explain what straight breakouts are in just a second. All right. First of all, we are going to be focusing on the 3 types of breakouts that we will indeed be profiting from. This one we don't want to take. This one we cannot take, or we will not be able to take. Okay, so these are the 3 types of price action where we are going to make our pips, our profits. First of all, the breakout pullback continuation type of price action around the London market open. That's the most common one. Okay, that's the prototypical type of London open breakout. All right, basically what this is about is if we have on the 1 hour time frame on our setup chart the Tokyo band, okay, the Tokyo range, that's 3 a.m. Eastern Standard Time, the London market opening time. All right. Well, obviously you want to project a little bit the Tokyo band, searching for that breakout. Well, at 3 a.m. you zoom into the trigger chart, into the 15 minutes time frame, searching for breakouts either to the upside or to the downside. Correct? Well, you zoom into the 15 minutes time frame. Let's assume we get a breakout to the upside, okay? And therefore, actually, let me mark that with an actual line. Just give me a second. Alright, here we are. Again, this would be the 15 minutes time frame. This would be the upper and the lower band of the Tokyo range. That would be the beginning of the European markets to 3 a.m. Eastern Standard Time. Well, assuming price have been ranging nicely and conveniently so throughout the Tokyo range, at 3 a.m. You zoom into your trigger chart, searching for your actual entry, correct? Well, the type of pattern we are going to base our entry on is the breakout pullback continuation pattern, which basically looks like this. As the euro markets open up, you usually see a momentum push. Remember, you want to see a nice candle, full candle with a long body, okay? Short wicks either to the upside or to the downside. Basically, you want to see a candle with a long body breaking through the Tokyo range boundaries. All right? So, upon that initial breakout, we are not going to be taking this trade. We are not going to be, as a whole, you usually want to avoid bracketing the range by placing a buy order just above the range or a few pips below the lower boundary of the range. Okay, you don't want to do that. Why is that? Well, because the London Open breakout is prone to fake breakouts, and if you just do that, you will be caught up in many fake breakouts. Okay, that's another type of price pattern we're gonna see in a moment. Okay, but as a whole, you never want to simply put a buy or sell order beyond or few pips beyond the range boundaries. What you want to do is to base your entry around that breakout pullback continuation pattern, which is exactly what I am explaining here if I stop rambling rambling on and on and on. Okay, breakout move. what you want to see, again, you will not trade this initial breakout. You will wait. You want to see a pullback on the 15 minutes time frame, retesting breakout levels. In this case, the upper boundary of the Tokyo range. What you want to see is price up on that initial breakout, price confirming that this breakout is a valid breakout and not a fake breakout. Okay, and if it is, if the market as a whole, as the consensus of the market as a whole is that this is a valid breakout, you will most likely see a momentum push in the direction of the original breakout. Okay, this being the original breakout, this being the retracement, and this being the second momentum push. Well, this is where we are going to make our money, on the second push, guys. You don't want to make money on the first push, you want to make money on the second push. All right, on the second push up in the direction of the original breakout. So again, on the 15 minutes time frame, the type of pattern you want to see is this type of pattern. All right, now the key idea here is to identify the actual pullback. That pullback can take the shape of, or can take two different shapes: a full swing retracement, which is the other type of breakouts, the other type of patterns we are going to be looking, or as established, the breakout pullback continuation pattern. Now this pullback maybe let's say 2 or 3 bars in a row. Obviously the first breakout, this would be a green bar, okay? Then a little bit of a pullback, maybe 1 or 2 or 3 red bars retesting that breakout point, okay? And from there you want to see another green bar, okay? Green bars from here pushing in the direction of the original breakout. This pullback again can take place, from 1 bar all the way from 1 bar to 3 maximum. You don't want to wait more than that. Please remember that this is a 15 minutes time frame. So if we have 3 red bars in a row, that means 45 minutes worth of price action combined with the actual breakout candle, okay, with the actual breakout push, then we are at least at least already 1 hour into the London session. Again, you don't want to wait too long before you jump on board. You want to take your trade as early as possible. So let's assume we get our breakout push, 1, 2, 3 maximum red bars retesting that level. Sometimes you don't get price to retest that level right to the pip, okay? Sometimes price dives indeed within the Tokyo range. My usual rule of the thumb is, as long as price doesn't break the mid band of the Tokyo range, that's okay, all right? As long as, let's assume we get, let me pause the video 1 second. All right, there we are. This is the midband of the Tokyo range, okay, located at 50% of that range. Well, as long as price upon the breakout doesn't quite retrace beyond that 50% band, then it's okay. You can continue searching for trades in the direction of the original breakout. Once price breaches through that midband of the Tokyo range, that 50% band, then we would not be looking into a breakout pullback continuation pattern, but we would actually be looking into a fake breakout. Basically, we would consider that early morning breakout as an actual fake breakout, and then we would be searching for reversal formations, for reversal price patterns on the lower band or on the opposite band of the Tokyo range, trading the opposite direction of the original breakout. The breakout pullback continuation pattern aims to make money in the direction of the original breakout. The fake breakout pattern aims to make money on the opposite direction of the original breakout. This being the original breakout, this being the direction we will be trading if we get a fake breakout. Again, the way as of which I recognize that a breakout is not going to be an actual breakout, but rather a fake breakout, is whether price respects up on the breakout and up on the pullback, whether price respects that 50% band. More often than not, you see price, the pullback actually, stopping around breakout points, around that Tokyo band. On occasionally it doesn't, on occasionally it dives in. Again, as long as it remains on the right side of the Tokyo range, then it's okay. All right, it's okay to continue searching for continuation moves. So we get the breakout, breakout push, initial push, then a little bit of fair retracement, all right, and then price, goes through a second push. There are two courses of action: the aggressive way or the conservative way. The conservative way, place your buy entry just above the high for the breakout level, for the breakout swing. Okay, this be not the original breakout swing, so let's say a couple of pips above that point, that swing turning point before the retracement begins. Well, that's where you locate your buy order. All right, so as soon as the continuation move, the second momentum push I was mentioning before ticks just above that breakout point, all right, well, we would be effectively filled in the market with our buy order, and we will be looking to profit from that up move. All right, that's the idea here. The stop loss will be located just immediately below the retracement point. All right, again, couple of pips is okay. You don't need to stretch your stop loss all the way behind the other end of the Tokyo range. You don't need to stretch your stop loss all the way behind the mid band. As long as you place it a couple of pips behind the pullback of this breakout pullback continuation pattern, well, you are okay. You can place your stop loss right there. All right. We'll be talking about targets just in a little while, okay? Please bear with me. As far as the entry, again, couple of pips above the breakout point, stop loss, couple of pips below the pullback aspect. Obviously, the other way around holds true if we get a breakout to the downside, okay? If we get this type of breakout, all right, that would be our entry there, that would be our stop loss, all right? Okay, so that would be the conservative way of trading the breakout pullback continuation pattern. Now, what's the aggressive way? Well, if we get our breakout 1 or 2 bars as a pullback, the aggressive way would be to trigger our long entry to click on our buy button as soon as price begins to, as soon as the retracement comes to an end, and you feel, again, I must stress that you feel that price begins to move in the direction of the opposite breakout, of the original breakout, without waiting for price to actually tick above the high for the breakout point. Okay, the whole point of the aggressive way of triggering this entry is to get your entry as soon as possible. On occasion, if the breakout, the initial breakout move happens in quite a momentum, well, price can span 30 pips, easily 30-40 pips, okay, and therefore by the time you get your entry as per the conservative way, well, you would be entering your trade, let's say, 30-40 pips, maybe 42 pips if you take the spread into consideration, away from the actual breakout point, which again is the Tokyo bands. Well, the aggressive way tries to, let's say, squeeze your entry as tightly as possible from that breakout point. All right. Certainly, the aggressive way aims to take the entry much closer to the actual bounce point, okay, to the actual end of this pullback, and you don't quite wait for the continuation part. Okay, basically, the breakout pullback continuation pattern is what we would call the conservative way. The aggressive way, well, we could call the breakout pullback bounce pattern, because we want to take the entry as close as possible to the bounce point. Now, before I was stressing on the word feel, okay? Breakout, pullback, you take your entry as soon as you feel that price is beginning to turn around. This takes experience, guys. All right, this is not something that you will gauge within your first or your second trade. You will need to take quite a few London Open breakout setups, okay, quite a few trades in order to gather up that experience. And believe me if I say that it will all become more intuitive as you take trades, and you will gauge an idea of when the retracement has come to an end and once price begins to turn around. All right. Disadvantages of the aggressive way: again, you need to gather a little bit of experience before taking this type of trades. Okay, at the beginning you may want to simply focus on the conservative way, playing or placing your buy stop order there and your sell stop order right there below the swing pullback. Advantages of the aggressive way of trading this type of price pattern: is way more efficient as per the risk-reward ratio. If you nail down your entry as tight as possible from the bounce point, let's assume you take your entry there, that will be your buy entry, and your stop loss would still be located below the end of the pullback. All right, that will be your stop loss. Well, as you can see, the risk on this particular trade is much smaller than if you actually wait for the entire breakout pullback continuation pattern to to be completed, to be confirmed. Okay, that means that if your target price, let's assume it's somewhere in there, right? Well, the conservative way will be aiming for this many pips and will be risking this many pips. The aggressive trader will be aiming for these many pips and just risking these many pips. That's why I was saying that the risk-reward ratio is obviously much more, well, let's say beneficial to your account as per the aggressive approach. Okay, but again, you got to be extraordinarily nimble. Okay, this is intraday trading, guys. This is a 15 minutes time frame, and the trading decisions happen on the fly. You've got to take those decisions on the fly, and therefore you've got to be very nimble. But in order to trade profitable trades on the fly, you need experience. So at the beginning, my recommendation is that you go for the conservative way, okay, and wait for the entire breakout pullback continuation pattern to be confirmed, instead of just jumping on board as price begins to begin that second push. Okay, not the initial breakout push, but the second push. You need a little bit of experience to recognize that, or to get the feeling of the beginning of that second push. Trust me if I say that, again, it will become more and more intuitive as you gain experience. Okay, we are looking into the sterling pound against the Japanese yen, obviously 1 hour time frame. We're going to be focusing on that part of the video there. All right, okay. Blue day or purple day, uptrend, Tokyo range, okay, right there, Tokyo range at the tight and sideways Tokyo range at the upper extreme of the previous day. So all in all, a valid setup. Now we're gonna be focusing again on that part of the chart. Let me draw the Tokyo range boundaries, that being the low for the Tokyo range, okay, and again I'm gonna mark the high for the Tokyo range. All right, right there. Let me count the bars. 1, 2, 3, 4, 5, 6, 7, 8. That's where, that's where the London market opens up. All right. So now we are gonna be assuming we will be following this type of this chart actually on real time. Well, we would zoom into the 15 minutes time frame right there as the London market opens up, searching for either a continuation move from this uptrend or for a reversal move in this uptrend. Okay, searching for a reversal day. All right, let me zoom into the 15 minutes time frame. Give me a second. All right, there we are. Let me squeeze that in a little bit. Here we are at the 15 minutes time frame, the trigger chart, or what I call the trigger chart. Anyway, we can easily define or visualize the validity of the Tokyo range on the 15 minutes time frame. Please see how price has been indeed moving sideways, okay, throughout the Tokyo session, with a clear upper boundary and a clear lower boundary for that Tokyo range. Okay, so certainly a valid Tokyo range. Anyway, London market opens around there, more or less around there. And well, at that time, obviously, we would be zooming into the 15-minute time frame, searching for our breakout. Now, actually, let me extend the Tokyo range boundaries a little bit more. That's the upper boundary, and this is the lower boundary. All right, so we get the breakout, okay, nice breakout to the upside, nice move to the upside, and then please see, do you see, guys, that retracement there? Let me zoom in a little bit more. I hope you guys can see that better on the, if I zoom in a little bit more. All right, there we are. That's the, again, the London market opens around there. Whoops. Around there, and then we see a momentum push, okay, in the first hour, 1, 2, 3, 15 minutes time frame. In the first hour, we see the momentum push we were talking about, and then please see how we get a pullback to retest the high, all right, the high for the Tokyo range, okay, the swing point that, well, we based our upper boundary on. All right, that's the swing high for the Tokyo range, and therefore that's what we mark as the high for the Tokyo range as a whole. And then, well, upon the breakout, what do we get? A 1 bar pullback. Before I was mentioning that you get the that these pullbacks can be can take the shape of 1, 2, or 3 bars. You usually don't get more than 3 bars pullback. All right. More often than not, it's a 1 bar, 2 bars, something like that. And obviously, in the opposite, the color of the actual bar is obviously in the opposite direction as the breakout bar, okay, as the breakout candle. Obviously, if the breakout takes place to the upside, the pullback, by definition, needs to go to the downside, and you can easily identify that pullback by the color or the bar. Of the bar, okay, the color in itself of the bar. In this case, this time around, it's just a 1 bar pullback. Again, anything between 1, 2, or 3 bars is okay. You don't want to see bars, long pullbacks, okay? You don't want to see 5, 6 bar pullbacks. You don't want to see that because, again, if the pullback takes, 4, 5, 6 bars, okay, 15 minutes bars, that means that the pullback in itself would be taking over 1 hour time span in itself, just the pullback. That's, this is a momentum field strategy, as I've mentioned a number of times. So both the breakout, right, and the pullback needs to happen in momentum, and also, well, the continuation move, obviously, okay? At the end of the day, you don't want to wait that long for this whole pattern to develop, all right? Again, 1 bar pullback, retesting right to the peep, all right? Right to the peep. The swing high for the Tokyo range, right to the peep. This is a mint perfect breakout pullback continuation pattern. You don't always get them this beautiful, okay? On occasion, you get the breakout, the pullback down here, again, as usual, as long as it doesn't breach below the midband of the Tokyo range, right? As long as the pullback doesn't go all the way down here. If the pullback was something like this, it would be still okay, all right? Okay. So how do you go about entering this trade? Just a couple of pips above that level, that's where you click on the buy button, or that's simply where you click or you place as soon as you see this breakout pullback pattern. You simply place a buy pending order at that level. Okay, if you don't know what a buy pending order is, just search for on Google FOREX buy stop order, and well, you will find plenty of definitions around on the internet. Okay, buy stop order. And where would you locate your stop loss? Well, if that's your entry, that's the end of the pullback, that's where you locate your stop loss. All right, buy point, sell a stop point, and well, we will talk about targets in a future video. All right, that would be the conservative way of trading this setup. The aggressive way, well, You spot the breakout. You spot the let me actually expand that a little bit more. You spot the breakout. You spot the pullback, retesting right to the peep, the swing high for the Tokyo session. And from there, what do you get? You get a green bar. You see that, a green bar in the 15 minutes time frame. Well, as soon as you see that green bar, that price respecting or retesting right to the peep, that swing high for the Tokyo session, and from there beginning to bounce to the upside, you would click on the buy button at the close of that bar. Okay, at the close of this first green bar, all right, the close happens right there. That's where you will click on your buy button. Again, this is something that you gain, that you can experience as you obviously as you trade more and more these type of setups. Okay, like anything else in in life, experience is a great bonus, and well, this is something that you will get experience as you trade more and more. Okay. Whoops, I'm sorry guys, I minimized the chart by mistake. All right, so conservative way, breakout, pullback, continuation, your entry there, your stop loss there. Aggressive way, breakout, pullback, bounce right there, you click on your buy button. That would be your entry, that would be your stop loss. All right, obviously with a better risk reward ratio, aiming to take your entry as close as possible to that bounce point. Alright, well, just to make sure you fully understand the breakout, pullback, continuation pattern, I'm going to show you another one this time around on the cable. Okay, sorry, the cable is the sterling pound against the American dollar. In case you don't know, they forex traders like to give each particular currency pair a different name, just as a nickname. Okay, some sort of a forex lingo. Cable is the sterling pound against the American dollar. Fiber is the euro against the American dollar. That's an I there, fiber. The loonie, all right, the loonie is the American dollar against the Canadian dollar. The GEPI, let me write that down. Oops, sorry. GEPI, that's the sterling pound against the Japanese yen, etc., etc. Okay, like I said, just forex lingo there. Anyway, cable, sterling pound against American dollar, 1 hour time frame. We're gonna be focusing on that breakout there, that Tokyo range and that breakout. Even though, well, I could easily explain this one there. Tokyo range, breakout to the downside. Okay, second move. But anyway, let's just focus on this one here. All right, so clear intra-week trend. All right, Tokyo low, Tokyo high at the extreme of the previous day's range is happening at the lower end of the previous day's range, etc., etc. All right, let's just label it as a valid Tokyo range and therefore a valid breakout. Let's zoom into the shorter time frames, but first of all, let me mark the let me just mark the Tokyo boundaries in themselves. That's one there, and that's another one there. All right, now let's zoom into the 15 minutes time frame. Let me actually search that range in my chart. All right, there it is. Let me properly mark the range boundaries. It won't take more than a minute. Okay. All right, there we are. Upper Tokyo range there, lower Tokyo range there. Price nicely flapping sideways throughout the Tokyo range. Let's see exactly when they right there. That's where the London market opens up. All right, momentum breakout, a 1 bar pullback. You see that 1 bar pullback? Let me squeeze that in a little bit more. This time around, again, we just get a 1 bar pullback. Again, guys, I must repeat, this thing happens in momentum. Okay, you don't have that much time to think. You've got to be very nimble as soon as you see the breakout move to identify the pullback. Again, your best way to identify pullbacks as the London market opens, once price drives away from the Tokyo boundaries, either the lower one or the upper one, is by searching for bars or candles with the opposite color of the actual breakout. Obviously, the breakout being breakout to the downside prints the bars in red, obviously in red. You want to search for a green bar. Okay, you want to search for a green bar or a conjunction of 2 or 3 green bars. All right? 1, 2, 3 is okay. So once you've gotten the breakout and once you've spot the reversal bar, right, the reversal candle identifying the breakout pullback, now you've got to wait for the continuation move. All right, the continuation move again happens in momentum. This time around, you really wouldn't have that much time if you were an aggressive trader to actually trigger an aggressive entry. Okay, because the breakout pullback continuation pattern happens just so quickly. As you get this bounce to the downside, well, you wouldn't really be able to squeeze your entry any tighter than a conservative trader would do. Okay, please note how your entry from a conservative point of view would be just a couple of pips beyond the pullback bar, in this case the green bar. Okay, so that would be your entry, your stop loss, few pips above the pullback bar as well. Okay, so that would be your stop loss, that would be your entry. In an aggressive way, an aggressive target, I'm sorry about that, an aggressive trader wouldn't really have any better entry than the conservative one, because it just happens in so much momentum. Okay, you at the end of the day, when you are trading intraday setups, again, decisions are taken on the fly, and well, you don't really have that much time to ponder up on your entry. Okay, so breakout pullback continuation pattern happens this fast, and well, that would be your entry at any rate. Okay, stop loss again aiming for a continuation move in the direction of the initial breakout, and as I zoom out, okay, in the continuation, this would be a continuation move from a, let me zoom out a little bit more, okay, from the previous downtrend. Okay, downtrend into a Tokyo range and a momentum continuation move. Okay, that tiny little bar there, now that I've squeezed out my trade, that's the pullback aspect of the breakout pullback continuation pattern. All right, well, now that we've explained what the breakout pullback continuation pattern looks like, and now that we know that we don't want to profit from the initial breakout, but instead we want to wait for the pullback, and around that pullback we want to base our entry in order to, well, profit from the continuation part, okay, from the second push. All right, from the second push, not this one, guys, but this one. Well, now we can go back and explain what the straight breakout actually is, and it's nothing but a breakout pullback continuation pattern where there is no pullback and there is no continuation. Basically, it's breakout that happens in just so much momentum, all right? As the London market opens up, there's just so much volatility, so many order tickets going into the market that price never looks back. It takes off without you, it never looks back, it never gives us any type of pullback, it never gives us any type of continuation. We cannot basically have any type of pullback candle in order to, well, base our entry few pips above that actual candle. All right, it just never happens, and well, like I say, price takes off without you, never looks back. There is not much you can do about that. That's why I was saying before that momentumless breakouts are breakouts you can trade, but you do not want to trade, or rather, you are able to trade, but you basically do not want to do it. Well, straight breakouts are rather the opposite. Okay, you wished you could trade them, but I'm afraid you will not be given the chance, okay, the possibility to jump on board on time. All right. So whenever you see a straight breakout, I'm going to show you now a couple of examples when well, you know, the actual breakout at 3 a.m. Eastern Standard Time happened in this much momentum. Well, whenever that happens, I am sorry. There's nothing you can do about it. Okay, it's, you know, just enjoy price cruising away without you, and just wave goodbye. There is no much else you can do about it. All Alright, well, here we are back into our charts, looking at the sterling pound against the Japanese yen, the Kepi on the 1 hour time frame. We're going to be looking or focusing on that particular breakout there, and how we actually, well, this is a momentum breakout. Obviously, that's a momentum breakout that we will not be able to profit from this time around. Nice downtrend, isn't it? A nice tight sideways projection throughout the Tokyo range, nicely located at the lower extreme of the previous day's range, basically a valid setup. Now, let's mark as usual the Tokyo range boundaries, that being the high there. Just a second, guys, that being the lower boundary. And now let me zoom into the 15 minutes time frame. There we are. Let me redefine the boundaries there and there. All right, when does the London market open up? The London market opens there, right there. All right, so momentum breakout, guys, momentum breakout. Do you see how you never got a breakout pullback continuation pattern? By the time you began, or price began giving you a green bar, price had already moved from 143.30 down to 142.26, over 100 pips. In fact, to be exact, 104 pips. That's just way too much, okay? Price has run over 100 pips. Now, do you really want price to retrace another 100 pips and another 100 pips to the downside? No, I'm sorry, that's just not going to happen. And if it happens, that's not a trade you want to take. And obviously, you don't want to take any trade around here. There you got, actually, let me zoom in a little bit more. Just a second, guys. All right, right there, at the end of this down run, we begin getting those green bars, okay? That, well, you could think, okay, there we are having our, finally we are having our pullback. That's not where you want the pullback to happen. You want the pullback to happen around breakout points. Because again, if you take any entry around there, price has already moved 100 pips. In order to make money here, you need price to continue pushing down, or you expect price to continue pushing down. After a 100 pip run, really, or rather 150 pip run ever since the beginning of the London session, I mean, really, that's pushing your chances way too much. You want to locate, or you want to see the breakout pullback continuation pattern at round breakout points, okay, in order to retest as nicely as possible, okay, as nicely as possible, the lower band, in this case, of the Tokyo range. Again, you can get price diving back in a little bit into the Tokyo range. That's okay, but you don't want this type of breakout pullback continuation patterns. You want price to retest or to give us the retracement bars or single bars. You never know how many you may get. 1, 2, 3, depends on the setup. Well, you want to see those bars around here. So once the pullback dies out and price is ready for another momentum move, well, you can simply place your buy stop order, and there you have plenty of room, okay, to make money out of this second continuation move, this second push in the direction of the original breakout. Whenever price, simply pushes price that far away from the actual breakout point, I'm sorry, this is not a trade you should be looking to trade anymore, right? How far is too far? Well, I mean, at what point should you be considering, assuming you are following this chart in real time, you see price driving away from breakout points, at what point you should stop considering taking any entry here? That really depends. That really depends on each particular currency pairs, but if price is driven beyond 50 pips, all right, beyond 50 pips, that means that either you get the pullback and you search for an aggressive entrance around an aggressive entry point, just very nicely and very tightly. Okay, let's assume, let me recap a little bit. Let's assume breakout, the breakout drives price 50 pips away. from entry point, you don't want for a full swing down, okay, and to take your entry 50 pips away, 50 plus pips away, beyond or away from the breakout point, okay. You don't want to wait that more. If price has driven, the breakout has driven price 50 pips beyond the Tokyo boundaries, if you get that pullback to retest this area, either you squeeze an aggressive entry as the bounce begins to take place, or you may want to consider, forgetting about this setup altogether, because you don't want to take that entry 50 pips beyond or away breakout points. That's too much for me, okay. Again, because the risk reward ratio, as we mentioned on a previous video, is just too poor, all right, too poor. You want your entry around there, so your entry is somewhere in there, your stop loss is somewhere in there, and your target price is there. If your entry is around there, that would be your stop loss, meaning you would be risking these many pips just to make these many pips. It's not worth it, guys. It's not worth it, okay. So as a general rule of the thumb, straight breakouts, if you get price if price moves 50 plus pips away from the Tokyo boundaries, if you get the pullback, either you get an aggressive entry or you forget about it. And if you get your pullback, okay, your pullback bars that far away from the Tokyo boundary in itself, again, you should be considering, or actually not considering, you should not take that trade at all. I repeat that, you should not take that trade at all. All right. Here's another fine example of a straight breakout on the sterling pound against the Japanese yen again. Okay, this is a high momentum currency pair, by the way. For all of you who don't know, the sterling pound against the Japanese yen is a very fast moving currency pair. Okay, so straight breakouts are usually happen on sterling pound crosses, much more so than on euro crosses. Okay, just because the sterling pound crosses carry a higher momentum than euro crosses, it's just the nature of the currency pair in itself. All right, well, what do we get here? Well, Tokyo range. Oops, let me clean that up. Tokyo range at the end of an up move. So this breakout is a counter trend breakout. The Tokyo range takes place at the higher or upper extreme of the previous day's range. All right. Anyway, I'm not gonna zoom into the 15-minute time frame. There is no need. You can see how this being the low of the Tokyo range. Take a look at that, man. Take a look at that. Huge, massive momentum from all the way from 146.20 to 145.11. So that's 109 pips. 109 pips within 1 hour bar. 1 hour bar, guys. 1 hour bar, 1 hour, the hourly time frame, 109 pips within the hour. That's a massive breakout. Okay, actually, let me go into the 15-minute time frame. This won't take more than a minute. Take a look at that. This is funny. Tokyo range. All right, breakout right there as the London market opens around that time there. All right, huge, massive move. See where let me mark the actual Tokyo range low there, right? See where we begin getting our retracement bars. Way too far from the breakout point. The pullback is far too detached from breakout from the lower boundary of the Tokyo range. All right. And obviously, by the time you get this breakout pullback continuation pattern, price is just so far away that the risk-reward ratio is extraordinarily poor. You don't want to take that trade, all right? By the time you begin getting those pullback bars, price is 100 pips away from breakout points. That's a no-go. So, recapping a little bit, straight breakouts, unfortunately, are something that you will not be able to trade 90% of the time unless you are lucky enough that the pullback comes back all the way to retest that level and you are able to squeeze a nice aggressive entry around there. All right. Okay, so straight breakouts out of the way. breakout pullback continuation patterns out of the way, momentumless breakouts out of the way, full swing retracements coming up next, guys. This is gonna take just a moment, just a minute or two, because it's gonna be very easy to understand. All right. Higher boundary of the Tokyo range, lower boundary of the Tokyo range. Let's assume a breakout to the upside. As per the breakout pullback continuation pattern, we were looking to in the 15 minutes time frame, we were looking to find this type of entry pattern. Okay, a breakout pullback continuation pattern. Instead, the full swing retracement is going to be a breakout in which we are not going to either we are going to miss, just because we were late, we missed this entire breakout pullback continuation pattern, or we got a straight breakout and we never got the pullback at reasonable levels, meaning around breakout points. So assuming either we miss this breakout pullback continuation pattern or price simply takes off without us, the full swing retracement basically we are going to be simply waiting for price to simply swing back to the high of the Tokyo range. All right, or again a full swing within the Tokyo range, but at no point, at no rate, breaking below the midband of the Tokyo range. Okay, we don't want that to happen. As long as the retracement ends in the upper end of the upper half of the Tokyo range, that's okay, or just immediately above the Tokyo high. But again, remember, we want a full swing retracement. That means that you want price indeed to retracing to this area. Otherwise, if it doesn't, we would be looking into straight breakout, as I just showed you a minute ago. Okay, remember when price took off and we begin getting our retracement bars up there, but at no point coming back down to retest the high for the Tokyo range. Well, that we don't want to trade that, because we would be in a straight breakout market scenario. We want in a full swing retracement for price to actually come back down here. Now, in full swing retracements, you usually can indeed spot the retracement in the hourly time frame, in the setup chart in itself. Okay, because price has moved away, and then by the time you begin getting the retracement, okay, the pullback bars on the 15 minutes time frame, price has moved away so far from the breakout point that we need to get multiple 15-minute bars signifying that pullback, and therefore adding all those 15-minute bars, that usually means that you indeed get to see a red bar on the 1 hour time frame. All right, now let's imagine this was the 1 hour time frame. The full swing retracement would look like this: a momentum breakout with a massive green bar, in this case, since we are looking for an up breakout. Then we would get a pullback bar, which would be red. Again, this is on the 1 hour time frame, guys. Okay, on the breakout pullback continuation pattern, we search for this price pattern on the 15 minutes time frame. We are now looking into the 1 hour time frame. Okay, so you would see a green bar on the 1 hour time frame, then the pullback, a red bar signifying that retracement, and eventually from here you want to begin seeing another continuation move. Obviously your entry this time around can only be aggressive. You cannot, I repeat, you cannot place your buy stop order, your buy pending order right there as we did on the breakout pullback continuation pattern, because price is just too far away from the upper boundary, okay, from the breakout point, probably, again, I must repeat, 50 pips plus, and, well, again, the risk-reward ratio would be too poor, not worth taking. So your only course of action here is to see up on the pullback, okay, up on this red bar has come to retest breakout points or the upper half of the Tokyo range. Well, you want to see price to beginning to curl upwards and begin printing in the 15 minutes time frame. Please mind that we trigger off the 15 minutes time frame once you see that breakout. And once you see that 1 or even 2 bar pullback, okay, on the 1 hour time frame, again, this is the 1 hour time frame. Once you see this first green bar or two green bars signifying that full swing retracement on the 1 hour time frame, you want to zoom once again into the 15 minutes time frame and begin searching for green bars in the direction of the original breakout. All right. At this time, all the way until there, we've been following this setup on the 1 hour time frame. From that moment on, we zoom back again into our trigger chart. All right. I mean, we can do all this process in the 15 minutes time frame. Why not? Yeah, sure, you can do that. That's entirely up to you. Depends on what time frame you feel more comfortable with, what time frame is, you spot the trading opportunity, the better. Well, it's entirely up to you. Like I say, you will usually see these one or two red candles on the 1 hour time frame. From that moment on, once the retracement has driven price back to breakout points, you want to zoom again into the 15 minutes time frame, and as soon as you see price again printing red bars in the green bars in the 15 minutes time frame, you can assume that this full retracement has come to an end, and now it's time to begin searching for your buy entry once again. Obviously, the stop loss goes again behind a few pips behind the end of the pullback, all right, and aiming to shoot for the second breakout, the second push in the direction of the original breakout. Okay, basically we are doing exactly the same as we did on the breakout pullback continuation pattern, but on a longer term perspective, in this case the 1 hour time frame, and we would not be looking to trade conservative entries. It's just too far away from breakout points. We would only be interested in taking aggressive entries right there as price in the 15 minutes time frame begins to print green bars in the case of an uptrend of a breakout to the upside, okay, green bars in the 15 minutes time frame once again. All right, well, we are looking into a euro cross for a change, the euro against the Japanese yen, 1 hour time frame, of course. We're going to be focusing on that part of the chart, all right, that's the Tokyo range right there. But at any rate, let's assume that was live market action. Okay, we sit at our trading station at that time of the day. We look at the previous day's trend. We can see how we've had a little bit of an uptrend. Purple day, maybe not the most beautiful uptrend in the world. I agree. I mean, the high for yesterday had been just a little bit higher than the high for the previous day, and the same for the lows. Okay, the low for yesterday just a little bit higher than the low of the previous day. So at any rate, we could label this as a mild trend. All right, a mild trend, but an uptrend nonetheless. Anyway, the Tokyo range nicely happening at the upper end of the previous day's range. Okay, the range moving sideways, price action moving sideways within the Tokyo range. So all in all, looks good. Now, let me zoom in a little bit more. Okay, right there. All right, so this is the Tokyo range there. Okay, I'm just going to mark the high for the Tokyo range since the breakout eventually happened as a continuation breakout, okay? So as the London market was opening, we got the breakout, okay? We got the breakout, and we can see how we can spot the full swing the full swing retracement on the actual 1 hour time frame. If we zoom into the 15-minute chart, this bar will probably represent 3 or 4 bars on the 15 minutes time frame. 3 or 4 red bars, okay, red bars, bringing price all the way from up there to retest okay, retest more or less breakout levels. All right, so in the 15 minutes time frame, you should see probably 3 or 4 red bars in a row. That's why I was saying before that full swing pullbacks, you can easily identify them on the setup chart in itself. Okay, you get a nice momentum move, a nice breakout bar, okay, which in fact, this is the low for the Tokyo range. This is the mid band. All right. No, actually, this is the low for the Tokyo range, and the mid band should be somewhere in there. You see how price actually retraces within the Tokyo range once again. That's been the high. Price pulls back, but at no rate it breaks beyond the 50% band. Okay, it doesn't break beyond that point. All right. So that can be considered still it can be considered still a valid pullback, okay, as long as it doesn't breach below the midband. Course of action at that point, once we see this breakout move, this pullback bar, and this retracement to the upper half of the Tokyo range, well, course of action, zoom into the 15 minutes time frame. As soon as price begins to print green bars, click on your buy button and off it goes. All right. Actually, just let me zoom into the 15 minutes time frame. Let's scroll. That's the okay. That's the high for the Tokyo band. Okay, right there. Sorry, the high for the Tokyo range. Okay, right there. That's the nice breakout move. Okay, whoops. That's the pullback. All right. Let me expand this a little bit there. All right, well, that's the pullback there, and as you can see, price begins to print green bars there. Well, as it prints the first green bar, as this green bar closes there, that's where you would click on the buy button from an aggressive point of view. You don't want to wait for price to actually break or take out that previous high, which would happen right there. You don't want that. As you can see, from that moment on, price simply loses momentum. How is that? Well, because price has already moved. Quite significantly so. Okay, it's already moved quite a run. So you want to nail down your entry as tightly as possible there. Whenever you are entering a full swing retracement entry up on the London Open breakout, again, you want to be rather aggressive with your entry. As soon as the 15 minutes chart is giving us green candles, right there is where you would go long. Okay, searching for this second push up on after the initial breakout. Alright, well, now that we've already seen how to trade the breakout pullback continuation pattern, we've seen what the full swing retracement is, let's take a look at the third type of a strategy or entry you're going to take under the London Open breakout strategy. We've already seen that momentumless breakouts are not our cup of tea. We are not going to take those setups. We are also not going to be able to profit from straight breakouts, and therefore, as the London market opens, once price breaches through the one boundary of the Tokyo session, well, just for a change, let me pick the other end, the second, the lower boundary of the Tokyo range. Well, obviously, as soon as London opens and price breaches through the Tokyo session, what we want to do is to zoom into the 15 minutes time frame and to search for our typical breakout pullback continuation pattern, which again, as I mentioned at the beginning of this video, 50% of your entries, around 50%, are going to be based on this particular one. Okay, it's the standard type of entry you're going to be searching on as per this strategy. So you are going to be searching obviously for the breakout pullback continuation pattern, correct? Well, on occasion, price doesn't quite give us that pattern. Instead, it breaks through in momentum, but just as fast it dives back within the Tokyo session once again. It breaches the mid-band of the Tokyo range, and eventually, actually sooner than later, it won't take long until price takes off in the opposite direction. How is that? Well, this is probably a little bit of stop-loss hunting. In case you are not familiar with stop loss hunting or stop loss triggering or stop loss running, there are many ways of calling the same thing. Well, stop loss hunting basically is large institutional traders artificially driving price with their massive trading volume. Okay, again, I must repeat, those are the guys who move the market. They have the trading volume to affect the market. Okay, so what they do is on occasion, they drive price, they slap a massive order, driving price in one direction, okay, just to hunt all those stop losses or entry orders that are located just immediately beyond a support or resistance level. At the end of the day, the Tokyo range is nothing but an intraday level of support and resistance, correct? Well, so what they do is, assuming this is the lower band of the Tokyo range, all right, that's the upper band, what they do is they slap a massive order in order to, well, drive price through one particular boundary. All those people who were looking to go short click on their sell buttons there. That's why we don't bracket the range, guys. That's why we don't just place a buy order 5 pips above the Tokyo range or 5 pips below the Tokyo range. You don't want to do that precisely in order to avoid stop loss hunting. So these guys drive price in one direction. They trigger the orders from all those people, simply bracket in the range. Immediately after, they reverse their position, price comes back in. Probably all those guys who went short, who sold that currency pair right there, probably are now scoring losses. Okay, they are being well, their stop losses are being hit, and from there, what they've effectively done if they've taken out all those traders out of the market, okay, they are now buying onto this currency pair of those stop loss hunting, and from there, well, price moves in the other direction. Please mind that whenever an stop loss order is taken, in this case, the stop loss for a short entry, for a sell entry, if you went short there, you sold. Let's assume the euro against the currency pair. Well, you sold it there. Your stop loss is nothing but a pending buy order. All right, a pending buy order. Basically, an order in the opposite direction to the one you originally took. Okay, that's the definition of a stop loss. Well, if a trader who's scored a loss, meaning those guys who sold here, if those guys who scored a loss need to sell, or rather now buy, that asset that they previously sold, well, they need to buy that asset back to the market, okay, in order to reverse their position. They sold one lot of the euro American dollar there. In order to exit the position, they need to buy it back. All right. Well, guess who is buying those lots for the euro American dollar, for example, or any other currency pair? Guess who is buying? Guess who are buying those lots for that particular currency pair? The same guys who artificially drove price down. Why would they do that? Well, because instead of buying here, they are buying down here at cheaper prices. Okay, they are basically forcing price to move in one direction so they can buy it back at a cheaper price, instead of just waiting for the Tokyo range to give way, right, and therefore to enter their buy orders here. What they do is they artificially trigger those stop losses, knowing that they will be able to buy or to enter along on that market at a much lower price of those stop loss orders they themselves triggered. Do you see how nasty that is? Okay, it really is nasty, but I'm telling you guys this because it's something that happens, and it's something that happens very often. The price nature behind a fake breakout, you've probably seen fake breakouts as a level of support and resistance in the market. Price is breaching through, seems like it's gonna move up, but then immediately after it turns around and it moves in the other direction. That is just stop loss hunting. Basically, a big trader who wants to enter a market at a better rate. All right. So again, price giving us a fake breakout of the lower band of the Tokyo range. Those stop losses are being hunted. Okay, those stop losses are being triggered by large players, so they get to buy that currency pair here instead of there, they are buying in at cheaper prices. Very nasty, but it does happen. All right, so how do we trade fake breakouts? Well, we are gonna, as usual, early in the morning, we get the breakout, we zoom into the 15 minutes time frame, we don't get the breakout pullback continuation pattern, price that I've seen. We are going to be searching for a breakout pullback continuation pattern. Once price breaches through, obviously, the midband of the Tokyo range, and later on, whenever it breaches the other and the other band, the opposite band of the Tokyo range, we're going to be simply switching our bias and, as usual, search for our typical breakout pullback continuation pattern, also on the 15 minutes time frame, based on the opposite band of the Tokyo range. Okay, so we want to see exactly this: fake breakout, price dives back in, breaks through the other band, and then we want to see this type of breakout. Okay, that's what we want to see. We are simply switching our bias. If we didn't get the entry here, if we didn't get our breakout pullback continuation pattern of one boundary, whenever price, if eventually price breaches through the opposite band, chances are, again, this was stop loss hunting, and the real market directional bias for the rest of the trading session is going to be to the upside. Okay, so you've got to be ready. Even if you took a trade here, even if you got fooled into this market, maybe you got the breakout pullback continuation pattern, whatever they might be, or maybe you just jumped into the trade too early, whatever the case might be, if you see that price eventually turns around, breaches through the other end, please search for that trading pattern in the opposite direction, okay? In order to, well, since you didn't profit from this move, at least you will be able to profit from the next move. Again, even if you scored a loss on this one, just because you scored a loss the first time around, it doesn't mean you should be giving up on that particular on that particular setup, on that particular currency pair for the rest of the day, because again, you might get the opportunity on the other end of the Tokyo range. All right, so again, fake breakout, pullback continuation pattern on the opposite direction, course of action, same as usual. That would be your entry, that would be your stop loss. If you want to be aggressive, you can try to squeeze your entry as soon as possible there once price begins to turn around up on the pullback. Okay, that's the course of action. Simply searching for that currency pair, for that trading pattern in the opposite direction, in the opposite end of the Tokyo range, as of where you saw the early morning fake breakout. Now, fake breakouts is something that happen very early in the morning. Okay, you will rarely see price taking its time, pulling a fake breakout, and eventually moving in the other direction. You will most likely, most of the times, you will see the fake breakout just as the European markets open up in the morning. Even before the London market opens up, okay? Maybe the fake breakout is driven by Frankfurt traders, which, as you know, wake up 1 hour earlier. So if you see a fake breakout very early in the morning, all right, again, chances are you will very soon see a breakout in the opposite direction, okay? So you can still profit from that move. Okay, euro against the Canadian dollar in the 1 hour time frame. Clear downtrend. Okay, we're actually going to focus on that part of the video. All right, we have that Tokyo range. Let me mark it as usual with some lines on my chart. All right, and there goes another line on my chart. All right, there we are. So a clear downtrend, okay, as per the last few days. A range at the lower extreme of the previous day's range. All right, horizontal price action through Tokyo. See how price moved sideways. Well, London market opening there, and see that price spike there. Do you see that price spike? That's a prototypical fake breakout, a prototypical stop loss hunting practice by the large institutional traders. All right, basically, again, as I was saying before, the drive price, this case to the upside. All the people who were looking to, or who were willing to take counter trend moves, well, they triggered their entries right there. They obviously got filled. They got into the market as per that spike, but as price retraced back down, they obviously scored a loss. Okay, their respective stop losses probably got triggered right away, and eventually price moved into the real directional bias that it was going to take, or it was meant to take, for the rest of the day. Please remember that this is an artificial move. Okay, that's not the real move by the real market move. It's artificially driven by the by stop loss hunters. Okay, by institutional large traders. Obviously, if they wanted to enter, the institutional traders wanted to enter short, would you rather take your short there or there? Obviously, you would want to enter your short there, right, rather than here. So again, what they do, drive price in one direction, and then they feed their short positions of those stop loss orders from people who entered long anywhere in there. All right, and from there, well, they let price move on its merry way to the downside. Again, if you see a fake breakout early in the morning and eventually price reversing, all right, reversing just as fast. Okay, please mind that the reversal move is just as fast as the breakout in itself. Well, if you see that type of move early in the morning and eventually a breakout in the other direction, chances are the real directional bias for the rest of the day is going to be to the downside. All right. All right, another quick example, the sterling pound against the American dollar on the 1 hour time frame, clear downtrend as per the week. We're going to focus on that part of the video, all right, of the chart. Tokyo range, 1, 2, 3, 4, 5, 6, 7, 8. The London market opens in there, all right. Right there. Let me mark the high and the low. You're probably seeing already what I mean in my chart, don't you? And let me mark the high for the Tokyo range. Oops, sorry, I messed that up. Okay. Right there. Well, as I was saying before, 3 a.m. Eastern Standard Time, the London session opens up there. Nice trend as per the last few days. The range, the Tokyo range, having price moving sideways at the extreme of the previous day's range, etc., etc. Everything looks good, and then the London market opens, and see that? Do you guys see that? What do you reckon that is? Again, please mind the fact that we see a long wick, all right? Price breaking up, but coming back down to close within the range again, all right? That's not a solid breakout candle, okay? Remember that solid breakouts are usually, or give us usually, a full candle with a long body and short wicks, both to the upside and to the downside. We don't get that, do we? No, we don't. What we get is a long wick breaching above the upper band of the Tokyo range, hitting all those stop losses, and then immediately after, as I was saying before, once it breaks through the opposite band of the Tokyo range, it usually gives us the real directional bias for the rest of the trading session, all right? And that's where our pips, our profits should be made, all right? If we spot the reversal on time, if we spot the fake breakout on time, our job as a trader is to be waiting once price actually breaches through the other end, to be waiting for price to actually, give us the entry on the opposite direction, on the opposite band of the Tokyo range. That's where the real money is to be made for the day. Okay, as long as you don't get fooled, as long as you don't get tricked by the market in there, even if you do, you can still get a second chance to profit on the second time around, okay, on the second breakout. Whoops, sorry, I minimized the chart by mistake. Anyway, let me now zoom into the 15 minutes time frame there. Let me scroll forward. All right, that's the fake breakout there. Okay, do you see how we don't quite get the breakout pullback continuation pattern? We get the breakout push, we get the pullback, but price up on the pullback. Do you see that 1 bar pullback, the red bar? Actually, let me zoom in a little bit more. All right, do you see the red bar signifying that pullback? Well, up on that, price didn't tick above the breakout thrust. Okay, this being the breakout thrust, this being the pullback, then price didn't tick above the first push up. Okay, it didn't. That's why we want to wait, always want to wait for the breakout pullback continuation pattern. This pattern is the confirmation of a breakout from a technical point of view. If you just get a single breakout, that simple breakout can still become or turn into a fake breakout. If you wait for the breakout pullback continuation pattern, chances are, once the pattern is completed, chances are the breakout is going to actually pull through and price is going to continue moving in the direction of the original breakout. Okay, this time around we didn't quite get that. Price simply failed to keep on pushing into that direction. Eventually it broke in the other direction. Course of action: simply wait for a breakout pullback continuation pattern, or, such as in this case, a full swing retracement. Okay, please take a look at the setup chart once again. I am back into the 1 hour time frame. Do you see how up on the breakout we can see the pullback bar signified by that green bar there? We can see that on the 1 hour time frame. All right, we are now dealing not with a breakout pullback continuation pattern, but with a full swing formation. Okay, we are not going to let me zoom back into the 15-minute time frame. All right, we don't see the breakout pullback continuation pattern there. Do you see that? Price instead simply moves away fast from breakout points, and then by the time we get our first pullback bar in the trigger chart in the 15-minute time frame, price is too far from breakout points. We've already seen that previously on this video. Therefore, course of action, we need to wait in case we get a full swing back, which we do, a full swing retracement back. We do have it, okay, we do get it. If we, instead of that, we simply got a breakout, one or two, let's assume we only got these two retracement bars, and from there price continue moving to the downside, we just wouldn't be able to take that trade, because by the time we got the entry, that would have been way too far from breakout levels, okay, from the Tokyo range in itself. Instead, this time around we got lucky. We did get the full swing back to retest with a number of green bars. Okay, do you see all those green bars there? Okay, green bars coming back to retest breakout levels once again, and then course of action, once again we follow an aggressive stand as far as taking our entry. We wait for the pullback. Once price touches or retests that breakout point, we wait for the pullback to be completed, and we wait for the first candle in the direction of the original breakout. Since the original breakout took place to the downside, the retracement obviously is to the upside, and then we wait for the first bar on the trigger chart that begins driving or begins moving price after the bounce in the direction of the original breakout. In this example, we want to see a red bar. That's the first red bar upon price bouncing or retesting that former Tokyo lower boundary, right? So how would we deal with this situation? We simply would take our entry right there, okay? As we got the first red candle, as that candle closed right there, that's where we would enter the trade. Stop loss, as usual, few pips beyond or above the pullback aspect right there, and off it goes. As I was saying before, once you get a fake breakout early in the morning, that's where London market open, and once price after the breakout, after the fake breakout, breaches through the other end of the Tokyo range, chances are the real direction for the rest of the day is going to be to the downside. Okay, so you've got to be ready for either breakout pullback continuation pattern or a full swing retracement, all right, in order to get your entry, your aggressive entry, as tight as possible from the bounce point. Now, a final word of warning as far as fake breakouts goes, okay? If price gives us a fake breakout, turns around and breaches through the other direction, and then it gives us another fake breakout, okay, and then it drives back within the Tokyo range beyond the mid band of that Tokyo range once again, just cancel that, okay? The market is too chaotic that precise day. The market does not have any real directional bias, and therefore what do we get as a result? Price flapping up and down. What have I been repeating throughout all these videos? You cannot make money when price is flapping sideways. Price needs to have a directional bias in order to make money. So if you get two fake breakouts in a row, first to the upside, then to the downside, or the other way around, okay, it doesn't really matter, first to the downside and then to the upside, and eventually price goes back within the Tokyo range once again, just cancel that. Search for trading, stop searching for trading opportunities there, search for trading opportunities in some other currency pairs, because chances are, well, the market as a whole is rather confused, or rather chaotic, and there is no clear directional bias, and more importantly, there is not going to be a clear market directional bias for the rest of the day. Chances are, if you get a second breakout, that price will continue to simply give us fake signals all day long. You don't want to trade under those market conditions, right? And well, and that's basically it, guys. We've already seen all the 5 different types of London Open breakouts: straight breakouts, breakout pullback continuation, full swing retracements, fake breakouts, and momentumless breakouts. We've already reviewed all that. I hope all these 5 patterns, I was able to drive the point home. You may want to rewatch this video, this long video. I'm sorry, I know I've dragged this video a little bit too long, but nonetheless, you may want to watch it again before we move on with the London Open breakout. We continue presenting new concepts as far as the London Open breakout strategy goes. All right? Okay, I'll see you in the next video. Bye-bye.